Now, this panel is here to discuss the value and the importance of the public equity markets. With the UK economy in certainly a more robust position, with, I think, a level of confidence about the future, the question is, are the public equity markets able to provide the necessary platform for companies in the future? Are they working effectively, and can they actually be better organized and regulated? One of the key issues that has been frequently raised is, why is it so expensive to raise equity? And that is one I'm sure that will be addressed by the panel. I think that given that most of the notes I was given, Tim has stolen most of the points. I'm not going to repeat bits of the sentiment survey that we do, but I think there are some critical issues which are worth highlighting, which is that 69% of small and mid-cap quoted companies believe investor interest has increased in the past 6 months. And I'd like to repeat that the oft-quoted claim of the QCA of the significant role we played in getting AIM shares into ISAs that clearly made an impact on that. I think there has been some concern around the issue and the impact of IPOs on those existing listed companies. 54% of small and mid-cap quoted companies in our recent sentiment survey believe the IPO valuations since the start of 2014 have been too high. I'm sure that issue will come up. But 44% of small and mid-cap quoted companies believe that the current uptick in the IPO market is helping their ability to raise secondary finance. Again, I'm sure this matter will get covered by our panel today. Now, on our panel, first up, giving what I describe as the independent perspective, supported by a lot of research and analysis, is Matt Isaksson from the OECD. He gave me a bit of a scare this morning. He was not here when Tim stood up on the panel, and having read in the paper that we had an air traffic control strike over France, I was a little concerned that we might have a no-show. I'm delighted to say he came by train. We have Giles Hargreave, representing the fund management industry, and then we have the right of reply to Alexander Justham, known I think by everybody as JJ, to give a view from the markets, or the market operators. I'm going to give them as much time as we can each, roughly about 10 minutes, to leave time for questions afterwards. A little bit of overrunning by our MP, but we therefore stand between you and a cup of coffee, so we'll try and get either on schedule, but I'm not going to cut them off short, given the topic is so important. Matt, over to you.
Thank you very much, Michael. I do like this. This is not an independent view at all, because Michael and I had a conference call about this session, and he told me what to do. So that's what I'm going to do. What I'm going to present and talk about is part of a bigger project that we have in the OECD in my department about the role of investment and economic growth. And the fact of the matter is actually that, and these are a couple of the reports that we've turned out so far, because we're part of this link between investment and growth includes the financing of investments, obviously. If we first look at growth, it's actually striking that we know very, very little actually about how to get growth from a public policy perspective. I mean, if we knew, we wouldn't be where we are, would we, right? Japan would not have had zero growth for 20 years if we actually knew what levers to use. But it is important information in retrospect, and I think all economists agreed. It's one of the strongest relationships that we know is between economic growth and capital formation. Capital formation consistently accounts for about 60% of the contribution to economic growth. Now, capital formation obviously requires capital for investment, and this can come in different shapes and forms. We all know that, from loans to credit cards and trade credits. And what we have focused on at this phase is the role of equity. And I don't have to tell you, but you would be surprised outside of this room when I talk also to fellow economists, even in the OECD, not to say politicians, how little they know about the difference in the character between different kinds of capital and the different kinds of services that different kinds of capital provides to corporations. So that's why I always try to tell them that equity is unique in the sense that it is really the only kind of capital, that's standardized capital, that is compatible with entrepreneurial uncertainty in the true sort of Knightian sense of the word uncertainty, which is very different from risk management, of course. And this makes us, and I do this very quickly, and we can come back to it. So here we are, looking at the relationship between investment and growth, the role of financing for investment, and the different kinds of capitals that are required. We are doing bonds as well, don't worry. We're going to have a big study on the corporate bond market coming out by the end of the year. But we started with equity, and particularly public equity markets, and we asked ourselves, what are the, if we want to look how well our economies work, what are the functions? What are the, from an economic perspective, from a societal perspective, what are the functions that we ask from a stock market? Well, first of all, we think it's the venue that should be able to provide access to equity capital for growth companies. We think it should also produce information that makes it possible to allocate capital in the most efficient way. I mean, the amount of capital is not the only necessary thing. There needs to be a certain amount, but just look at the Soviet Union. They had a lot of capital trying to reverse the rivers and whatever. You know, they threw a lot of capital away. We need efficient allocation of capital, and stock markets play an important role in that. We also need stock markets to help shareholders engage in the monitoring of corporate performance, both by exit and voice. And if we look at so what I'm going to do, I'm just going to illustrate very briefly, because we only have 10 minutes, the access, the allocation, and monitoring. I'm going to give some suggestions of not how we're doing maybe, but where we stand. And some of you may have seen our numbers on IPOs, which I think is the most comprehensive global data set on IPO activity in the last 20 years. What we did over the weekend, we updated the old IPO data that we have, but we also did another thing that I thought was relevant for this conference. Instead of showing IPOs on certain markets, in these reports we have, and it's been also in the papers, we show IPOs in New York, IPOs in London, etc., right? What we did this time, we went back in the whole data set and identified what countries do the companies come from, right? So UK companies, how many UK companies have made an IPO in a certain year, and what are the trends, etc. So that's what we're going to look at. Obviously, most UK companies still list in the UK, but there is a small discrepancy, and in some countries the discrepancy is larger. If we look at the entire OECD area to start with, you can see that there is we've divided this into 3 periods, and there is about half the proceedings in 2008 to 2013. OECD companies raised only half, approximately, of the amount of money that they raised in the period 1993 to 2000, and 2/3 of what they raised in the period 2001 to 2007. This is OECD, companies from OECD countries raising money through an IPO. If we look at UK companies for the same periods, what has happened is that UK companies' share of OECD IPOs has about halved. Is that a word in English, halved? Halved? Yes. Halved. Yeah, halved. Very good. Which in numbers, it means that it's gone from about, I think it was about 14 billion to about 3 billion or so. I mean, I'm not sure that these numbers are absolutely correct. But the share of the UK companies as part of the overall OECD IPOs has decreased quite considerably. We see the same downward trend also in the US. The average number of IPOs has fallen between, here we only divide it into two halves, the 90s and the 2000s. But the numbers of IPOs on average has fallen by 75%. But this average size of the IPOs have only fallen by 40%. And it actually means that and this may be important in this SME context, that the average size of an IPO in the US today is 3 times larger than it used to be. And this was one of the concerns behind the so-called Jobs Act in the US. So we see fewer but bigger IPOs. I don't know why I included this, but I think I'll jump it because time is too short. So this was about the access to capital. So UK companies basically have used stock exchanges to raise capital less and less. I mean, that's sort of a big number to take away. In terms of the allocation of capital, I think the basic story is that we are seeing more and more of passive investment products being used. I mean, indexing has been around for a long time. It is actually increasing rather than decreasing. And I'm only illustrating this with the increase in exchange-traded funds, which is sort of taking indexing one step further. And obviously, with these investment strategies, the important thing is obviously to select the index, to compose the index. But that's basically when you make your allocation. After that, your interest in individual companies, and particularly in smaller and growth companies, becomes quite secondary until you decide to change the index, which you may not be able to do because you have a client contract. When it comes to monitoring, which was the third stage in this investment chain, again, I can only in this time illustrate it by the universe of CalPERS, which I'm not sure that if you can see it, which is very complex, obviously. The bottom line here is that CalPERS is one of the large players in the stock market in the US, of course. They have stocks in about 10,000 different companies, half of them in the US, half of them abroad. And these companies, they claim, or they want, or at least they intend, I don't know, to monitor one way or the other by voting their shares or following these companies or whatever. So how do they do this? The main vehicle, I would say, is to use external proxy advisors and proxy consultants. CalPERS uses 3 different ones, all the 3 big ones. And they pay them each about $500,000. So how much governance do you get for $500,000 if you think about the fact that you have at least 10,000 companies to follow? Even if you use the largest one, which is ISS, they cover, I think, 40,000 companies in 100 countries with not very many staff. I calculated once that if everybody who worked for ISS was actually involved in monitoring annual meetings, they would have to monitor something like 10 a week, a year around, which nobody actually, which you can't do at any depth. It goes without saying. On the other side of the coin, in the case of CalPERS, they pay approximately $1 billion in various management fees for their assets. Almost half of that is paid to private equity firms. Private equity constitutes around 10% of their portfolio. They draw plus half of the asset management fees that they fork out, which is $500 million. I have no views on that. I only conclude that there is something here that tells me, maybe this is the price of good governance. If you want somebody to look after the companies, follow them closely, this may be what it costs. The fact that there are some other costs related to it is another matter, but you see the way I think about it. And I also know that the SEC are looking closer at the private equity firm fees, but in principle, in terms of the monitoring, these are the two extremes, if you want, and they all exist in CalPERS. But on the whole, our conclusion from looking at this phenomena, monitoring is typically done in box ticking today, and all these provisions that try to force institutional investors to vote. It can be stewardship codes, or it can be the ERISA Act in the US. Our conclusion from analyzing is that they are probably in vain. If it's not in your business model to vote your shares, you won't really want to do it anyway. You will just find a way to minimize the cost. You kick the can down the alley. You farm it out to somebody who can do it through computers at minimum cost. The ones that actually use their votes and use their engagement in corporate governance typically have no demands on themselves, regulatory or other, to do so. They do it spontaneously because it's part of their business model. So the last slide is just a few possible explanations why we ended up where we are in terms of a lower use of public equity markets for raising money. What we would consider less effective allocation of assets in the investment chain, and poorer monitoring. These are only 3 possible explanations. We're not saying that they are explanations, but Michael wanted me to put them up there just as food for thought and maybe even provocative. But they also correspond to perhaps, they also correspond to what have been somewhat of a sea change in the financial landscape over the last decade or so. There is no doubt. I mean, the business model of stock exchanges, fragmentation, everything, it has changed dramatically in front of our, before our very eyes. Institutional investment and investment strategies and trading practices have evolved extremely fast. Everything from algo trading to the ETF industry. And we also have a larger complexity in at least parts of the investment chain, with a lot of additional service providers who are now claiming a part of the cake. So that rounds it up. And thank you very much again for the privilege of being here. Thank you.
Well, Mats, I think we'll leave those dangling. And I just was going to halt the applause. We'll save that for the end when we've heard how our next 2 panelists respond maybe to some of that, or at least put their own case. Giles.
Thanks. Yeah, I'm going to do it over there. Is that okay?
That's wherever you feel comfortable.
Okay. Don't you think, by the way, this government's proving itself to be very pro-investment? I mean, I do. I think the least we can do is re-elect them. Good morning, everybody. My name is Giles Hargreave. I work for a little firm from Blackpool called Hargreave Hale, and we've developed a fund management business. And now we have, rather amazingly, £4 billion under our management, of which about half is in small cap. And actually, there are 34 companies in the room today of which we are shareholders. So watch out. We started investing in small cap unit trusts in 1998. Why did we choose small caps? Because the universe is so much bigger and much more exciting than big cap. There's over 2,000 stocks in the FTSE, small cap, fledgling, AIM, plus markets, and others, compared to what, 100 in the FTSE, 250 in the mid cap. So many more stocks to choose from and much greater rewards available. I mean, we've had plenty of losers in our time, but the key to investing in small cap is to maximize your winners. As long as you only lose your money once in your loser, you can make many times in your winners. And just a few examples. I'm not saying it always goes like this, but nevertheless, worth mentioning. A company called Advanced Computer Software. We bought at 17p in 2008. Today they're 117p and still going strong. Cove Energy, you might remember, it went from 20p to 240 in a couple of years, 2008, 2009. And I was going to mention the great Asos, I'm not quite sure how you pronounce it. Despite that little local difficulty recently, and we did buy them at 55p, and we did sell some at £67. The only thing was that somewhere in the middle, I did sell them and had to buy them back higher up, so I can't quite claim that one. But it does give you an idea of the money to be made in small cap and how much more fun it is than boring old big caps. At least that's what we think. Yeah, it's like my friend Jim Slater, who says that, as you famous expression, elephants don't gallop, but small companies quite often do. Now, for a long time, small cap was out of favor with institutions, and if you look at that chart, it shows you that for every year from 1997 to 2012, there was a net capital withdrawal out of the sector. Extraordinary, really, but that's what happened. It's only in the last 2 years we've begun to see money back in the sector. But despite that, there was very good performance available. And let's just look at this chart. Just before I say that, you may also have read an article by Ken Fisher in the FT. Anybody read it? No, okay. He said that he thought that small cap outperformance was a myth. Well, I'm kind of here to prove that it wasn't a myth, actually. His argument was that if you eliminate the 1 year after a bear market when small caps go up dramatically, then big caps might outperform. But that kind of seems like cheating to me. But anyway, if you look at that chart, it shows that over the last 10 years, I'll just step over here, if I can see it myself, the FTSE went up 119%.
Giles, you're going to lose your microphone.
Oh, am I? Oh, okay. Well, I'll stay where I am. Okay. What it basically it's showing you is that the FTSE's up 119%. The funds, which is the way to judge it, the best FTSE unit trusts are up 123%. The small cap index was up 131%. The average small cap fund was up 193%. And there was a little fund at the end here which was up 314%. Won't surprise you to know that's one that we manage. But I think that proves that certainly over that 10-year period, small caps smashed big caps. And I think they've continued to do so since then. And also, I think if you go back to 1970, you get a fairly similar pattern. So that's why we're in investing in small caps. Now, half of our universe is in the AIM market. And I honestly don't think that the tax breaks available in the AIM market are really appreciated yet. It's coming, but if you think about it, if you buy an AIM stock in your ISA, you pay no stamp duty as you buy it. For as long as you hold it, you pay no higher rate income tax on your dividend. After 2 years, it's free of inheritance tax, provided you keep the portfolio going. You can change stocks, but you must keep the portfolio going. And finally, if you sell the stock within the ISA, you pay no capital gains tax. Now that is a highly attractive combination. And I honestly think that most companies who are on AIM should think very carefully before moving off. And there was a company the other day that came to see us, and the CEO said, almost quite proudly, oh, we're going to think of moving up to the main market. And he was a bit shocked when I advised him against it. And I said, you don't realize how many of your shareholders are there for the tax breaks and are long-term investors, and you're going to lose them. And they're going to have to sell their shares, they're going to have to pay capital gains tax on the sales, and they're not going to thank you. Anyway, a couple of days later, I noticed an RNS came out saying that having consulted shareholders, they decided not to move markets. Good for them. So going back to the Hargreave-Hale method, such as it is, we believe in diversified portfolios, thus avoiding too much single stock risk and providing some liquidity. By the way, I just point out that if you invest via unit trusts, you don't have to worry about the underlying illiquidity of the stocks. You can deal T3, T4 any time you like, and you have complete liquidity, which actually gives a small investor quite an advantage over the institutional investor. We hold in excess of about 200 stocks, which is about 10% of the market, which I said there are 34, did I say, who are here today. And we have a team of 12 full-time analysts and fund managers to ensure that all our stocks are covered. Now, this doesn't mean that occasionally stocks go down and markets go down. And this is a chart of our fund from 1998 to today, and you'll see that it started at 56p, I think it says over there, and it reached £10.22. It's off a bit, actually. It's down again today at about £9.90. But what that shows is that twice during the period, firstly in 2002, 2003, and secondly in 2008, the unit price halved, or virtually halved, actually, but went down about 40%. So just talking to investors, I would urge you, if you are a small cap investor, to be a long-term investor, or a pound cost averager. I learned that, by the way, in an exam I had to do last year. So I thought it was a bit rough, actually, age 65, having to do exams. And I'm not saying I passed it the first time, but I did. But I did pass it. A few comments on IPOs, which there's been a lot of interest in. And I think on the bearish aspect of it is they are draining a lot of money out of the market into slightly strange companies. That's the first thing. Secondly, I think it's extraordinary how the corporate brokers, your normally friendly next-door neighbor, chappie, turns into this fierce vulture-like person with the prospect of selling an IPO. I mean, I don't know if you followed the AA saga, but I mean, that floated saga. Oh, okay, bit of a joke there. AA floated yesterday, rather unsuccessfully, you'll have noticed, it priced at 250, I think closed at 230. But the broker, Genkos, amazingly, raised 1.3 billion in order to take out private equity. Now, I've no doubt there were other advisors who had a share of that, but nevertheless, Genkos were forced to put out a reverse profit warning, saying how much money they were going to make this year, all from this IPO. So you can imagine, it's not surprising that there are so many IPOs, because they're so remunerative for the corporate brokers. And I think that needs to be looked at a little bit carefully in case the market gets swamped by these rather strange companies. I mean, RAC's coming as well, isn't it? We've had AA, we've had Saga. I don't know. There was also an interesting comparison between two companies which floated at the same time a few weeks ago. I thought I might just give you a little information on this because it does prove a point, I think. On the one hand, you have Card Factory, greeting cards company, I'm sure you all know. And on the other hand, Patisserie Valerie, patisserie company, owned at the time and still largely owned by Luke Johnson, who's going to be speaking later, whereas Card Factory was owned by private equity. Nothing wrong with private equity. And after however many years it is, they want to realize their investments. So they're very keen to sell. Anyway, they're both good rollout stories, both increasing their stall portfolios at about 10% per annum. There's actually a quicker payback on Card Factory. They get their money back in 1 year rather than 2. Card Factory had some debt, while Patisserie Valerie didn't. Card Factory was going for a full quote, interesting. Patisserie going to AIM. Card Factory quite a lot larger, but raising the same proportion of money, if you see what I mean. I think Card Factory raised about 290 million, and Patisserie Valerie about 80 million. Okay, you with me so far? So you would have thought that they would get fairly similar outcomes in terms of the pricing. Well, not a bit of it. Patisserie Valerie floated at 15 times 2015 earnings. Allocations were 40%. I'd love to get 40% on an allocation. It's just the right number. Plenty of interest, but a decent allocation. Anyway, 40% allocation and well oversubscribed, likely to be good aftermarket. 40% allocation, and sure enough, the stock went for 15% premium. And it's still there, by the way. And I'm a happy shareholder. I'm sure everybody else is a happy shareholder. And if Luke chooses to raise some money, wants to buy another brand, I'm sure we'll support him. Card Factory, on the other hand, floats at 13.8 times, i.e. about a 10% discount. Hello, you've got 100% allocation. Oh my gosh, when you get 100% allocation, you know you're in trouble. Stock opens, sure enough, at a 13% discount. Has recovered a little to about a 6% discount. So why was that? I guess one of the clues is that Luke was operating, not surprisingly, on his own behalf, and he was more anxious to create a good aftermarket because he was going to remain a substantial shareholder. Whereas on the other hand, the Card Factory owners, I suppose, wanted to sell as much as they could and as high as they could. But there was one other clue, which was the advisor list. It said, Patisserie Valerie, advisor, Canaccord, a specialist small cap broker. That's it. Card Factory, no less than 3 bulge bracket brokers and 2 other advisors. Talk about too many cooks. So, regarding small cap market in general, I guess my message to investors is that it's a great place to invest, provided you're there for the long term. If you're a company thinking of coming to the market, make sure that you put your new shareholders first. And if you're already quoted, remember to look after your existing shareholders, because if you do that, they'll look after you. Thank you very much.
Giles. Giles, many thanks for that. I'm going to move straight on to JJ, and we'll see if we can not eat too much into the coffee break.
Okay, I'm extremely cognizant of time, and I will try and sort of pull together a number of themes. I mean, the overall title here is how do we enhance public equity markets? And I think we've heard a lot, both from the Minister and all the other speakers, of the various issues. And you can imagine as someone who's running a stock market in a time of fairly healthy IPO volumes and fairly healthy markets, you know, it's almost churlish to sort of at one level ask the question of myself of what more can we do? But actually, my cup is definitely somewhere between your optimism and pessimism of sort of being half full. I think there is a lot more we can all do, but at the same time, I think we should recognise that actually we're not in a bad place, and a lot of things are actually working very well. The public equity markets have proven in the last 12 months that it can raise capital for companies, which is, as we've discussed, is actually very critical for growth companies. I very passionately believe that equity markets are, as Matt sort of referred to, the sort of key institutional instrument for actually managing entrepreneurial and growth risk rather than debt. That need to diversify our funding sources, as was referred to in many of the other speeches by the Minister, away from the banking industry is absolutely critical. And we should not forget, we do run here in the UK, we are fortunate, and many of you are all the actors who make it work. We just happen to host it, but many of you are the actors who make it work. probably still the most successful small cap market anywhere around the world. So in a way, we should recognize that fact, and we should recognize the way that it actually is working, and the number of very good companies that have come to the market recently. And I definitely feel AIM has matured, and it goes to many of Giles's comments. Actually, the type of companies coming to AIM, Patisserie Valerie being a very good one, also because actually I particularly like its products and have the waistline to show for it. But it's a classic case of the type of company that is coming to AIM, slightly more mature in its process, slightly larger cap as a result. That probably reflects some of the underlying changes of the funding prior to coming to public markets that also seem to be working quite well, and the kind of companies that we can see as very sustainable going forward through many cycles. So I think it's fair to say we do feel the public equity markets are quite well set up. We talked a lot about the tax components as well. The government has made material changes on that, and I do think now some of the imbalance between debt and equity and the tax basis has got better, and again, definitely better for AIM. Of course, we would love, the minister's gone now actually, but we would love obviously the minister to abolish stamp duty on all stocks. But AIM wasn't a bad start. But and just sort of rounding up my optimism before I get to the sort of cup half empty side of the equation, actually we do, despite often the perception, again, the UK marketplace actually has been a very good supporter of tech and the new economy. We can sort of cite many examples of actually, against often the popular perception, of companies that have come to the market, supported by the market for a long term. Monetize is a very good example. You know, as those companies grow through their businesses developments, they may not be making much profit at this stage, but certainly they are getting the recognition of the potential and the value. So I actually do think the UK markets are good supporters of tech. There's lots of good examples. Zoopla just came a few days ago, again, well priced and performing well. And the perception that the UK markets are really just an old economy marketplace, I really think, again, are not borne out by the facts. And exciting companies in that world, biotech as well, can really look forward to actually good support from the institutional and retail investor base. So where's the sort of cup half empty? Matt sort of referred to some of it. I still think we've got a long way to go to really develop an equity culture in our overall investment process. I still think we have a long way to go in the sources of finance for growth companies and starting companies to really diversify away from bank debt and bank credit. We really need to continue to support the diversification of that funding sources all the way through the funding ladder. If you look at how many of the graphs and many of the moments there from 2008 to 2012, which is really where, in essence, much of our economy dependent on bank credit and dependent on just a few banks, as they got switched off, and they did all get switched off, literally. They had to shrink their balance sheets rapidly for all the reasons we know. There wasn't the easy switch into all the other natural ways of funding for companies in the way the US managed to. And the contrast between the US and ourselves is extremely stark within that. And their ability to actually fund their growth and fund their economy, one, through the right instruments, i.e. more equity, and two, for a diversification of source away from just, say, 3 or 4 key banks, is extremely telling. So I still think we have a very long way to go within that context, and I think the tax system has something to do with that as well as just the straight diversification of sources of capital. We talked about the retail. I still think as a community, and we as some of you may know, we actually run the Italian stock market as well, and can always slightly compare and contrast ourselves between London and Milan. And one of the starkest things between London and Milan is the nature and extent of actual retail participation, say in Italy, and direct retail participation within Italy. Much, much, much higher than the UK. And I think, again, it's not that we don't have retail investors. This is all retail money in one way or another in the end. But the levels of intermediation of that and the inefficiency of that versus maybe much more direct participation of UK retail, or at least participation through just, say, one step, and therefore one set of fees and costs, is something I think we can all look at as a market and recognise that maybe we're not in as good a place as we could be, and certainly, again, in comparison to other marketplaces around the world. There are some notable exceptions to that. I can see Gavin looking at me straight away, but we need more of that, Gavin, is really what is really what I'm saying. And you look at the US, you look at markets like Italy as well. We could do a lot better on that, and there's a huge amount of benefits for that, both in terms of liquidity, but also in terms of actual just breadth of retail participation and experience that actually goes with that. But fundamentally, just to conclude, there is more we can do. The cup is, as I said, on balance, half full rather than half empty. But I think we should also recognise we're not in a bad place. Our markets are functioning pretty well. Good companies are getting capital. A diversity of companies are getting capital. If we look at the amount of capital and the various sources of capital that have been raised this year, we've got companies spreading from the high tech, spreading into the biotech. We've got fair degree of discount retailers. We appreciate that's very much a sign of our economic times. But the marketplace and the investment community is supporting a lot of breadth of companies and in a pretty healthy way. So we shouldn't take that away. We have a supportive government, as we've heard. They can do more, but they have already done a lot that has actually been very helpful in terms of liquidity. Liquidity in AIM, just on the stamp duty and ISAs, has materially improved, which has always been the great complaint of AIM, and we always understand that liquidity has been always the great difficulty in small cap, and we're making a lot of effort to make that better, and the government removing that tax has definitely made a major improvement. So really simply somewhere between the optimism and the pessimism, not a full signed up member of the EOR group, but not totally Panglossian and complacent either. We've got a lot more to do, but I think we should also recognise we've got a very healthy market environment here that hopefully can support the many companies that are here within this context. So I appreciate we've got very little time, so I will cut it there.
JJ, I think what they say when you hover between optimism and pessimist is you don't know. Now, in the interest of time, we inherited a 15-minute deficit. We'll make up a little bit of that, but I definitely want to create the opportunity for some questions here, because I'm sure, apart from anything else, there are 35 companies out there who want the opportunity to ask Giles a question without the need to actually necessarily divulge information. What we'll do is we give ourselves about a maximum of 10 minutes, and so anybody got a question for any of the panel? Or you want coffee so badly? Well, I will kick something off, because one of the issues, just so you're not going to get your coffee straight away, you have two extremes here, Matt. I mean, you were talking about this question won't necessarily come to you, so careful. The sheer extent of what the passive investment and the complete minimization of the cost associated with the interaction and engagement with the underlying company, whereas Giles has a business that is founded effectively on selective, on the complete opposite extreme to index management. Is there any middle ground on this, or is it purely that is driven by the economics of the investment community, and it's the only way to make it work? I mean, Matt, you can have first shot, and then Giles can follow.
No, I mean, there are probably those that are sort of technically speaking in between, but I'm a firm believer that it is your engagement in terms of what is sometimes called corporate governance, and even beyond that, is very much driven by your business model. If it is not part of your business model, if you cannot justify the costs that are associated with it, you will not spend the kind of money that Warren Buffett does on looking at annual reports. It's just out of the question. And also, I would say, I think there is talent is also limited. I mean, there are only so many people who can run 100 meters in 9.8 seconds. And that goes for more industry. I mean, there are only so many Gates out there, so many Buffetts out there. And the rest do best by having an index.
Giles, how do you make it work in terms of engaging with your underlying companies? Or is it, do you avoid box ticking? Do you use proxy agencies or box tickers for you?
No, we see the companies. We see like about half a dozen companies a day. I mean, we've invested in a big team of fund managers and analysts actually to do that. And the more companies you see, the more information you gather, because you don't just gather the information about the company you're seeing, but they'll talk about their competitors, they'll talk about the industry, and that's how you learn. So you also write quite detailed reports afterwards, so you've got a historical record, which you can always refer to for your for the next visit. And yeah, I mean, that's the only way for us.
Now, I knew we'd get a question now. Hopefully for JJ, or are you actually going to pick on one of the others?
There's a question for Mats, actually. It's Gavin Oldham here from Share
But
PLC
JJ
and Share
will
Centre.
answer it.
There was a phrase you used in your presentation, which I was really struck by, which is creation under uncertainty is the only the only genuine source of economic progress. We always, every time we get into a sort of political cycle about taxation, we get into a major thing about capital growth and income. And, many politicians think that the two are substitutable, as it were, and therefore ought to be taxed at the same rate. But you know, from what you've said in that phrase, and I know, that there's a heck of a lot of risk involved in taking equity positions and seeing capital growth. What's your view about how governments should tax capital growth? Do you think 28% is a reasonable rate for a higher for basically a higher rate taxpayer? Or do you think really that risk ought to be better recognized within the taxation system?
I seriously don't have a view. I think it is partly recognized today, but maybe there are others. I mean, there are others who are better placed to answer the question, actually, so I'll pass it on. Because it's a good question, so I don't want it to go unanswered, right?
I can see a Treasury official in the background there as well, so I'll be careful what I say. But I think I would echo your sentiment that recognizing that the taxation on capital should be different from income is essential, and absolutely would support that. And obviously there are many degrees of that, and when we move backwards, as we have done every so often, to sort of aligning those two, I don't think that's ultimately a healthy environment. So I think you have to accept that taking and investing and providing risk capital is so essential to the economy, and if you overtax it, you will actually get a negative result, or more importantly, you won't get people doing it, full stop, and with significant consequences. And then there won't be any income to tax at a later date.
And I don't know if Giles has got numbers, but I mean, the sheer increase in traded volumes in AIM stocks the moment they allowed you to put AIM stocks into ISA was substantial. Yeah. That is basically a tax haven. So that is the impact you can have from, it may not be viewed necessarily as marginal fiscal change to create the right environment, shows you the impact you can have by changing, marginal rates of tax, around capital.
But can I just say that on capital gains tax, I mean, it does skew portfolio management. Because after a while, after the stock's gone up enough, you just can't sell it. Because the tax, the liability is just too much.
So to give you the numbers, because I've got them here, we've had 16% increase post the the ISA change in terms of average daily value traded. And we've had, we're still, the tax on, the stamp duty is still a little bit newer, but overall, just as a different measure, the FTSE AIM all shares up 12% versus the all share up 5% since the stamp duty.
I don't want to in any way underestimate the importance of the tax discussion, but I would say one word of caution against, I mean, I think there are two things that we want to look at from our perspective, and this is whether there are structural changes in motion that affects the access to capital over the public equity markets. And I personally don't think that taxes haven't changed that much over our observation period, that would be a major factor. So I don't want to sort of create an, I'm not sure that we should create an illusion where taxes may solve something that is actually a longer term structural problem that we may need to address. And our ultimate objective is, you know, sometimes these politicians ask me, why are you running around defending these stock exchanges? You know, this high-frequency trading, you know, they do their money and they walk away and they are short-term and everything. First thing you need to do is explain equity is eternal. It's the longest kind of capital you can get, okay? They don't know that. They think this is high-frequency trading. Oh, it must be short-term. No. Anyway, but the second thing you need to explain is to say that all we are after, and I'm not hugging stock exchanges. The only thing I'm saying is that for a growth company that is built by an entrepreneur that may have a good future, different options of financing should be at least equal. There should be a level playing field and no discrimination against various avenues of financing. That's, I think, all we're saying. There shouldn't be over-regulation, shouldn't be overly costly to do an IPO. It shouldn't be overly costly to stay listed in terms of disclosure requirements and other requirements. Those are the things that we try to put on the table in order to say to them, to regulators and politicians, make sure that the growth companies, tomorrow's Microsoft, have a sort of, I don't know if level playing field is the right word, but they have this shop that is unbiased, at least, by regulation to choose from. And I think this in itself is because exactly what you said here, in terms of hard times, I think that also the costs of entering stock exchanges, especially in the US, is a big thing. It's increased tremendously, the first initial listing. And that's an obstacle to many growth companies. But I just wanted to come back to this thing about the stock exchange. Once you are listed, and we have statistics on this because we went through all the secondary offerings as well. Once you are listed, it's a very efficient way to raise capital and use as a buffer. We looked at the period, well, we looked at 20 years, but in the period when the banks closed down, right, we had record levels of secondary public offerings. We had record levels of companies that were already listed, didn't get loans, but reverted to the public stock market to create this buffer that they needed for a few years. I don't know how it worked in micro, but this is what the number shows in macro. And I'm giving him to JJ now.
I'm just going to give, if there's no, I'll take one question, and there's one being waved at the back. So now you've all woken up, we're going to have a question, and we'll try and answer them quickly and to the point.
Thank you, Michael. It was very welcome to see on Matt's slide that he identified investor monitoring and engagement to be one of the three functions of a stock market. I'd just like to reflect that back to JJ, just to ask him, in his view, whether we've actually reached the point where the encouragement of good governance is a function of the market, or is it just a behaviour that we are seeking to encourage?
I think it's a combination of stakeholders in that. I mean, it's a function of the rules of the marketplace, it's a function of the way the investment community behaves, and it's the function of actually the way just the corporates do it. So I don't think there's any simple answer to that. What is clear is that good governance and good monitoring and good stakeholder engagement between corporates and the investment community. Everything that in fact Giles is talking about, in fact he sees 6 companies a day, is the heart of actually the benefit for both sides of the equation. The rules, the regulations, the transparency, disclosures, sort of trying to, and governance codes, the FRC and everything else, try to give a framework around that. But actually, you can have a framework around that. In the end, what really matters is actually the actual engagement and the substance of it by both the corporates themselves and by the investment community holding the corporates to account on it. So there's no simple bits of it. It's a combination of all. And in fact, there's numerous examples of people who tick every box. I mean, I'm not a great fan of ticking every box, as you can imagine. There's numerous examples of people who've ticked every box under the sun and have collapsed spectacularly through unbelievable poor governance in substance as opposed to in form. So to me, the real issue is how do you get to the substance of what all these things are trying to achieve, and how do you actually walk the talk, both from the investment community and from the corporate community.
Thanks, JJ. Was there a question in the back? Otherwise, and that's a brave person who's going to stand between this room and a cup of coffee. Not that I would want totally to discourage anybody. In which case, first of all, can I thank our panelists? I think there are a lot of issues that we could carry on talking about for many hours, and I get marginally concerned when I see that Mats is sitting here with an OECD publication that he hasn't yet referred to. So I'm sure we could have gone on for some time. And just before I close, Tim made a football crack at the beginning. I do happen to hold a sweepstake ticket for Costa Rica in a company sweep. Anybody who wants to buy an interest in it, I'll be out by the coffee. In which case, thanks very much indeed. And Tim, back to you.